Yeah, like first and foremost, Nate, timing is everything, and this thing launches in April, kind of around the bottom of the market. So we benefited from a performance perspective from the market finding a bottom and rallying pretty aggressively off of that.
All right, joining me will be Paul Baiocchi, Chief ETF Strategist at SS&C ALPS Advisors, who currently offers 25 ETFs, over $18 billion in assets. And we'll get into this, but it's truly a unique lineup. So they have everything from an equal sector weight ETF to an electrification infrastructure ETF, an MLP ETF, a natural resources ETF, dividend-focused ETFs. There's some very interesting strategies. And Paul himself is a longtime industry veteran. He's a fantastic ETF resource. And so we're actually going to touch on some broader topics this week, including where he sees room for further ETF innovation and how issuers can effectively compete as more products are coming to market. We'll also get into crypto ETFs, along with the multi-share class structure. And then I do want to spend at least some time covering a few of those ALPS ETFs as well, which I think you'll enjoy because Paul always does a great job of tying their ETFs into the current market environment. I feel like he always approaches things from a macro level first and then how their ETFs can be a solution. So he'll join me here in a bit. To start this week, I'm joined by Todd Rosenbluth, Head of Research at VettaFi. And speaking of the multi-share class structure, if you haven't been paying attention to this, or maybe you have no idea what this even is, don't worry. We are going to bring you fully up to speed on everything going on here, because this will be a huge story once the SEC approves this, which theoretically could be any day now. And so without further ado, let me welcome in the one and only Todd Rosenbluth. Todd, always a pleasure. Thanks for joining me this week.
It's great to be back. Great to be back on camera with you.
All right, so this is a topic we actually haven't discussed in a while, this multi-share class structure, where there are now over 70 fund companies that have filed with the SEC to offer an ETF share class of their existing mutual funds, or vice versa, right? A mutual fund share class of existing ETFs, and actually several issuers have filed for both of those. But I feel like it's been a bit quiet here. You know, we heard the SEC say this was a big priority back in May. I think some in the industry, certainly including myself, got pretty optimistic that approval was near, but here we are still waiting. And so I guess before we get into the details of this structure, have you heard anything at all regarding an approval time frame here? Or do you have any expectations? Because again, this does seem to be dragging out a bit.
So my expectations are that this is going to happen in the fourth quarter, and this being approval of a few individual filings from a couple of firms that are going to get the first go-ahead. They're the ones that have been, I think, leading the charge. If I had to guess, Dimensional Funds and FM Investments would be two of those firms. And I think, as we'll get into in a moment, it's right that there's probably a couple of firms that help to set the pace and the tone and hopefully give asset managers and investors more confidence that this is a viable alternative to offer an ETF share class of an existing mutual fund, or, as you mentioned, a mutual fund share class of an existing ETF. I think I got both of those right. Hopefully I said it the way I had intended. To basically have a second alternative for investors. So I think this is going to be in the fourth quarter. What we have seen is that of those 70 firms that you mentioned, roughly 30 of them, and I'm using Ben Johnson of Morningstar as my source because on LinkedIn and probably other platforms, he does a weird update of numbers, but I follow along as to what's happening. I think it's roughly 30 firms that have refiled and updated based on what it seems like the SEC's focus is. So it feels like we're getting closer. I might have said that months ago, but this time, hopefully I'm right.
But it's interesting. So you think that we won't see a batch approval like with what we saw with crypto ETFs? Do you think it'll be more first come, first serve?
I do think it's going to be first come, first serve, as well as who is ready. And not that the SEC can't approve something, they often do. Something is approved and doesn't come to market first. I don't think of this in the same way as crypto. I think of this more in what we saw with semi-transparent active ETFs. And that's probably closer to what we're talking about, individual firms opting in. This isn't a race. These products are not going to start from zero. In fact, that's part of the point, is that there's an existing portfolio of assets. There's existing shareholders that would need to be done right by, as opposed to a race to see who can gather the assets. Because it's not the same assets. The investor base that's in a dimensional funds mutual fund that is looking for an ETF share class is not that same investor base that is in an FM investments ETF that's looking for a mutual fund share class. Likely two different shareholder bases.
Well, let's do this. Let's take a step back just to make sure we cover the basics for people who are unfamiliar with this multi-share class structure. Do you want to elaborate on what this is and why investors should care? Again, just to make sure we cover some basics here.
Sure. So we raced out of the gate, so I'm glad to back up a little bit. So for 20 years, Vanguard had a patent that allowed them to have the exclusive rights to offer an ETF and a mutual fund share class of the same portfolio. So if you're not investing in ETFs, you're only investing in mutual funds, you know that there's often an investor share class or an institutional share class or an A, a B, a C share class. Vanguard has only been allowed, because they filed a patent, to offer an ETF share class of an existing mutual fund. That's typically how it worked, that they launched a mutual fund portfolios and then added in an ETF share class. That patent expired in 2023. In the last 2 years, we've started to see firms seek approval. They have to seek approval to have the ability to offer an ETF share class of an existing mutual fund, or as we mentioned, the inverse of that. Why is that meaningful and why is it valuable? Well, for Vanguard, it was valuable in that it helped them to jumpstart their ETF business and continue to grow. It allows investors to benefit from the ability of an ETF. ETFs, as you and I'm sure the audience is familiar with, works through the creation and redemption process, which allows an ETF to be more tax efficient. So Vanguard's mutual funds have historically been more tax efficient than traditional other mutual funds because they've been able to tap into that. And investors are able, or through Vanguard, were able to convert tax-free an existing mutual fund share class into an ETF. And I presume the other way around. I never really thought of it that way, but presumably they've been able to do that. So now asset managers are seeking that same approval process. The main thing that I didn't say that is worth noting is that these will be all of these ones that have been filed are actively managed products, and that will be fully transparent. So that's a number of wrinkles here. The Vanguard products have been index-based. In fact, Vanguard is one of those 70 firms that has filed to do an ETF share class of an actively managed mutual fund. Let me pause. That was a lot. I'm confident I went down the rabbit hole too fast.
Yeah, actually, there are a few things I want to unpack there, but because this can get a little bit confusing, we both have alluded to the fact that some ETF issuers are pursuing a mutual fund share class, which I think might surprise some people because I don't want to paint with too broad of a brush here, Todd, but I think the fairly common narrative is that the mutual fund is sort of an outdated structure. You don't have to agree with that, but I think just from the outside looking in, that's how people would view that. And so do you want to explain why would an ETF issuer want to pursue a mutual fund share class?
Yeah, so FM Investments is one of those firms. I believe State Street is another one of those firms. I think in both cases, they might have filed to do both, an ETF to mutual fund and mutual fund to ETF version of it. But yes, I mean, this is ETF Prime. You have a website. I have websites that I work for that have ETF in the name. But mutual funds are still widely held by many people. They're held through 401ks and through other institutional platforms. Those platforms don't currently support or actively support, pun unintended on the active, but don't support ETFs. So if you're an advisor who has clients and you're helping them with their support their retirement goals and 401k, even if it's outside of your efforts, but you're advising them, this is important. I'm sure you do. Well, actually, I'm not sure. I'm sure most listeners own mutual funds through their 401k plan. I do. It's the only way I can get exposure to it. So if you are an ETF issuer and you want exposure and you want to tap into that, a mutual fund share class is an appropriate way to play both sides of the retirement market, both through taxable and tax-deferred accounts.
Yeah, I think that's well said. I think another way that I would put that is that, and I think you would agree with this, that a lot of the innovation that we've seen in asset management has happened on the ETF side and perhaps not as much on the mutual fund side. And so if an ETF issuer can offer a mutual fund share class in, say, a retirement plan, maybe that would give those investors access to some of this innovation that they otherwise couldn't have. So we'll see what happens. I'm still bullish longer term on ETFs ultimately making their way into 401ks much more than they have at this point, even though some of the benefits obviously don't translate in terms of tax efficiency and I would say even intraday tradability. But this is maybe a bridge to start getting us down that path. Let me ask you this: once the SEC approves this, and investors start to have access to both mutual fund and ETF share classes of the exact same strategies, because that's what this does, what do you think the decision-making process should look like in terms of choosing between the two? Because it seems to me like the easy answer is to just pick the ETF for all of the reasons we always talk about: cost and transparency, trading flexibility, those sorts of things. To your point, you have ETFs and some of your website names, me as well. So it just seems like that would be the easy answer. But how are you looking at that?
Well, I mean, let's level set for a second. In the month of July, U.S. equity mutual funds had roughly $370 billion of net outflows. I believe I'm pulling this from data that we saw from Lipper, whereas ETFs had $72 billion of net inflows. So the pendulum has been swinging away from mutual funds and certainly actively managed or equity mutual funds. That's just in July. I mean, it's been many years that's going on. So I think if you're asking for someone who's new to invest, ETFs are being the vehicle of choice over mutual funds if you're investing outside of the plans that we talked about. But I do want to caution, I don't think that when we see ETF share classes added to an existing portfolio, there's going to be a flood of money that is moving out. There's going to be money moving out of mutual funds and into ETFs because investors will want the tax efficiency. Some of them will want the tax efficiency. Some of them will want a cost savings. Some of them will want the intraday liquidity. But people have, and those people who've long held on to a mutual fund because they don't want to bear that tax burden could likely do some of that likely tax-free conversion. But I can think of two other groups of people who own mutual funds. The 401k folks that we talked about that really an ETF isn't a realistic alternative for them. And then the people who either don't even remember they own a mutual fund, or if they do, they're just comfortable. Like, I don't need this ETF. I'm comfortable in what I have in my mutual fund. And maybe they're going to get, and they might also get some of the benefits of an ETF share class because the portfolio could wash away some of those traditional capital gains. So if you do nothing, this is possibly a good thing for you as a mutual fund shareholder, but you'll have the option in some cases of doing so, being converting to an ETF share class.
Yeah, in longer term, I would expect the investor experiences in both the ETF and mutual fund. Obviously, those will converge over time because the mutual fund can take advantage of the tax efficiency of the ETF wrapper. I would think cost ultimately converge. Clearly, you're not going to have the intraday tradability in a mutual fund, but you and I could probably debate whether or not that's a good thing or a bad thing for investors. It depends on whether or not you like that optionality. But let me ask you this, Todd. Obviously, we always like to take a well-rounded view of any topics we cover. And so I'll ask you, what could go wrong here? You know, clearly the SEC has had some concerns around what they call cross-subsidization, where one class of investors is basically carrying an undue burden for another class of investors, whether that be on taxes or fees. And that's a big part of, I think, what's taking a while to get the SEC comfortable on this is they want to ensure fund companies have the proper mechanisms in place via, you know, the fund boards and those sorts of things to ensure that shareholders in either structure are treated fairly. But do you have any concerns here at all?
So I guess the short answer is to what the SEC might be concerned about and what you addressed. I don't have. Again, I'm going to go on faith. I believe that asset managers that are going to go this step, and again, not all of them are going to take this leap. I think they've lined themselves up so that they could do so. I don't think all of them are going to do so, and certainly not all of them are going to do so once they potentially get approval. But yes, first of all, treating shareholders fairly should be it doesn't need to be said, except let's say it, and it definitely is being said in the prospectus and all of the legal documents that's there. No shareholder should be hurt by any moves by an asset management company. I guess I could end there. I think accounting efforts by the firms, by the asset managers should help to ensure that anybody that's joining the portfolio in an ETF share class doesn't inherit the capital gains of the pre-existing portfolio for mutual funds. That's a hope. I hope that that's the case. I hope that the experience is as good, if not better, certainly better than in existing somebody who's buying into the mutual fund. And if that's the case, then you still get intraday liquidity and probably a better price point in that the expense ratio is lower. I guess my concern or my worst case scenario is that asset managers enter into this ETF marketplace using this opportunity to add a share class, and they're not fully prepared for it. Either that they haven't done all of the legwork, or they don't have the people on site to be able to help them out. They don't have that capital markets expertise. So trading an ETF and helping your shareholders trade an ETF is part of the job of an asset manager. So are these soon-to-be entrants? Can they navigate the ETF ecosystem? Do they have an ETF distribution plan so that they can hopefully grow in that marketplace? This is not easy to be part of the ETF marketplace. I don't think it's just an easy button to just add a share class and hope that investors are going to be happy or that you're going to find new of them. So I'm hoping that. So my worst case scenario, that was your original question, is that firms jump into the ETF marketplace and then realize it is a jungle. What is our friend Eric Baiocchi referred to as a terror dome? He does it from more of a competing standpoint. I think you just still want to make sure you're protecting your shareholders in this ETF marketplace and partnering with firms that can help you to do that.
It's a really good point, Todd, because we've been focusing our discussion here mostly from an investor or advisor perspective, and this plays into it. But if we look from a fund company's perspective, which is really the path that you're heading down here, I've talked before about how not every issuer is going to be ready to go on day one. And to exactly what you're saying, there is a lot operationally that has to go on behind the scenes to actually bring this to investors. And I could be wrong, but I think this is going to be particularly challenging for issuers who don't yet have an ETF presence, which there are not a ton of those left, but there are a few. And if they don't have that infrastructure, they don't have ETF capital markets teams and maybe have navigated market makers and authorized participants, and you start getting into the plumbing of ETFs, that could be a bit of a challenge. Or even for issuers going the other way, right? If you're an ETF issuer, maybe you haven't dealt with all the mutual fund plumbing. There's things that have to be learned there. And so this would seem to benefit an issuer as a strong presence in both markets already, mutual funds and ETFs. Going back to the investor side, and I don't know if you have any comments on this, is I was thinking through potential worst case scenarios of this. It seems like it would just be massive outflows from the mutual fund share class, triggering capital gains for the ETF share class. And I think we've seen a couple of examples of that from Vanguard, if I'm not mistaken, but that was way back in like 2008, 2009. Do you think that's the worst thing to happen, or that could happen from an investor's perspective? I agree with you from a fund company's perspective, some of the challenges.
So sure. I mean, since we're talking worst case scenarios, it's possible that enough money so either it's moving from the mutual fund into the ETF, or it's just moving out of the mutual fund because money moves out of because mutual funds have been bleeding assets. Yeah, it's possible. So I think there's two opportunities here. There's for people who are existing mutual fund shareholders who will convert into the ETF share class and get the benefits of an ETF, that it will be cheaper, that they'll have that intraday liquidity, that they hopefully will have a better tax experience, and that they won't get a capital gains bill just for doing nothing but staying loyal to the fund. So in all likelihood, they're going to be better off or the same, most likely better off. If you're talking about somebody new who's buying into the ETF and they have to pay a penalty because people are running from the mutual fund share class, that's possible. That's certainly possible. And so investors might want to be, you might not want to jump in as a new investor into the ETF share class right out of the gate. I don't think anybody should be jumping into this right out of the gate anyway. Let's figure out how this works. Let's see that it works from the outside looking in. And if you're an existing shareholder, then there's opportunity. But it's a way to tap into a different part of the marketplace more than anything else. So I don't think answering a slightly different question. I don't think we're going to see a huge number of products, and I don't think we're going to see a huge number of new investors coming into the portfolio. I think we'll be seeing mutual fund to ETF or ETF to mutual fund conversion of share classes of those investors. That's more likely to what we'll see in the beginning of this.
So it sounds like the takeaway, which doesn't surprise me, from Todd Rosenbluth, investors still have to do their homework here. You still have to look under the hood. You have to understand exactly what it is you're investing in, not just on the investment strategy side, but just the implications of being in either an ETF or mutual fund wrapper.
So yes, and I'll add a third part to it, that I think it will be important for investors and advisors in support of those investors to think about the firm. Normally it's the product, and obviously it's the performance record of the portfolio management, but back to the point of, does this firm that I'm now buying an ETF from, are they here to stay? Are they, are they committed to this space? Do they have the resources to be able to help me and my client or not? And so there are firms that have been doing both mutual funds and ETFs for a while. I think this is an opportunity for them to demonstrate that level of expertise. And so Fidelity and T. Rowe Price are a couple of firms that come to mind that's obviously started in the mutual fund world, that have a strong active presence, that have both ETF and mutual fund parts of their business. They've been blending those together. I mentioned some other firms earlier that are likely to lead the charge here, but I would put Fidelity and T. Rowe Price as a couple other firms that I'm watching, and they happen to also be firms that went through the semi-transparent, and in some cases still or in all cases, both of them, they have the product, so they have lessons learned as to how to do this. There are a couple of firms that I'm watching as they come, hopefully, to market, in the next 3 to 6 months.
Just to wrap up our conversation here, I'm getting the sense from you, and you're certainly positive on this overall, but that maybe what we'll see in terms of industry impact isn't necessarily as much as some of the hype that we hear out there. And maybe I'm just picking that up in the short term from you, maybe longer term, you feel a little bit differently. But talk more about that, just how you view the overall industry impact and maybe how you do see this playing out over the long term. Because I know I've been out there, and I even said at the top of the show that I think this could have a huge impact on the industry overall, but I'm not necessarily getting that sense from you.
So I do think that when we 3, 5, 10 years down the road, we look at a chart of the ETF asset growth, we will see a point on that chart with a nice spike up when this happened. The flows won't spike right away, but I think we will see in a couple of years, we will see a spike in ETF assets, and we will certainly see a spike in ETF products. I just don't think we're going to see it on day 1 or even on day 31, the same way that we did with Bitcoin products. There is demand for investors and advisors who want an ETF version of an existing mutual fund that there's a tax bill that they don't want to end up having to pay. They're locked into something. I just don't think we're going to see that many products, and I don't think we're going to see that many people who are chomping to knock down the mutual fund gate and get into the ETF and be an ETF shareholder for it. Do you?
I just view this as, this is a little bit of a cliche answer, they're just going to offer a lot more options for investors, in that I do think there are a number, and I think it's more on the mutual fund side of the equation, where those mutual fund companies and managers haven't wanted to bring, say, a clone strategy to market in the ETF wrapper, or they haven't wanted to do a mutual fund to ETF conversion because maybe the mutual fund has a lot of retirement plan assets. And so I do think this will bring a lot more investment strategies and options to the end investor. Now, is that a good or bad thing? I can make the case that it's already very difficult for investors to wade through the options that we have with the 4,400 plus ETFs that are on the market. But I think, you know me, my bias is always more options for investors is a good thing overall. I just think that it raises the bar for due diligence and education, which is something that I know, you think is very important. So that's one piece of it. But I think because there will be more options in the market, I do think there's a little bit of that additional supply helping to pull in demand, if that makes sense. I think we've seen that in active ETFs over the past few years, and that once some of these firms that have been comfortable bringing their best portfolio managers and best strategies to market in ETF wrapper, we've seen this fairly meaningful uplift of flows into active ETFs, right? Where active ETFs represent whatever 10% of industry assets, but have taken in 30 to 40% of flows. I think this will help provide an additional tailwind to that sort of momentum that we've already seen.
So I agree with everything that you say. It's the time frame that it happens in that I think you and I have some I'll go with my side, respectful disagreement on it. I just don't think the asset managers are going to be ready and eager to then unlock what they're doing that's working and that they're prepared for it. It's one thing to then, you can't, if you offer the ETF share class, you have to be ready for the investor to execute on it and have a good experience. And we need to have the platforms to be able to have that. We need to have the custodians to be able to have that. You mentioned all of the other things that need to exist. There's tickers, that have to, that need to be found that are similar to it. There's marketing that needs to be done. I just don't think I think we're going to see new products, ETF share classes of mutual funds this year and mutual fund share classes of ETFs this year. I think in 18 months, I hope I'll be back before then, in 18 months, we will have seen a meaningful change in the industry. But I don't think it's going to happen by the end of the year. I think it's going to happen more likely in 25, in 26 and into 27.
No, I think that's a fair assessment. And I would add, when you think about everything that has to occur, think about even just getting approval on wirehouse platforms or advisory platforms, because will those platforms just automatically allow these strategies that have already been traded in the mutual fund format to be traded in ETF? Maybe, but we don't know that for sure. And so that's just another point, I think, to what you're saying. There's a lot that has to happen here. But Todd, our conversations and debates are always respectful, and I always love the insight you provide. So great stuff this week on a topic that, again, we hadn't talked much about in a while because it's been simmering in the background, but I do think it's going to come here to the forefront in the fourth quarter. So thank you for joining me.
My pleasure. I know your next guest, Paul Baiocchi, is an expert in this, and he's on the inside. So hopefully he gives you some insights as to what his firm is thinking about on the ETF share class option.
I will certainly be asking him. That was Todd Rosenbluth, Head of Research at VettaFi.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Trader designs ETFs for sophisticated investors looking for leverage on the daily, monthly, or quarterly performance on stocks and ETFs. Leveraged ETFs involve significant risks. Consider the investment objectives, risks, and charges and expenses of the ETFs carefully before investing. To obtain a prospectus containing this and other important information which should be read carefully before investing, visit our website at traderetfs.com.
I'm now joined by Paul Baiocchi, Chief ETF Strategist at SS&C ALPS Advisors, who currently offers 25 ETFs with over $18 billion in assets under management in those ETFs. And they have a unique lineup that spans everything from MLP ETFs and dividend-focused ETFs to thematic ETFs. And Paul heads up the firm's overall product development and distribution strategy. I always say he's an excellent all-around industry resource as well. And he is now joining me from Denver. Paul, great having you back on the podcast.
I appreciate it, Nate. It's good to see you. Thanks for the opportunity.
Yeah, so I thought what might be fun is if we just start with some broader industry topics, because you are an excellent all-around industry resource. I feel like you cover the space as closely as anyone. And so I have a number of topics, but I thought maybe we could just pick up where I left off with our good friend Todd Rosenbluth, who was just discussing this forthcoming multi-share class structure, where, as you know, we have over 70 fund companies that have filed for an ETF share class of existing mutual funds, or vice versa. And in some cases, firms have filed for both. But before we get into some other ETF topics, any thoughts on this? Like, are you expecting this to be a big deal? Are fund companies ready for this? Any other hot takes?
Yeah, so I know just from experience that the spend, legal and operations that goes along with a multi-share class structure is significant. And so firms that are pursuing this have committed tremendously in terms of headcount, in terms of resources, and in terms of dollars to these initiatives, especially if they've gone and they've amended their filings, as we've seen the sort of cascading list of firms that have had to amend the filings based on, I would assume, feedback they're getting from the SEC. And so that's first and foremost. The firms that are doing this, I think, are committed to it. And then you have to ask the question, well, why are they committed to it? And I think part of it is you've got a list within the list of firms who don't really have an ETF footprint, don't have any meaningful shelf space or just overall adoption of their ETFs, and are trying to elbow into what is clearly the key segment of 40 Act, 33 Act, or otherwise product strategies in the marketplace. And so I think that's a signal that a lot of the firms who maybe feel like they've been left behind, maybe feel like this is their on-ramp to the ETF world. And in some ways, that's a good thing because it gives investors and advisors more choice from some compelling active managers or other asset managers who they haven't been able to access through the ETF wrapper. So in some ways, that's the good. The other part of it, I think, from the asset manager's perspective is instead of having to start an ETF lineup from scratch, they get, in theory, fast-tracked to their approval. And because distribution is so important to ETF success, I wonder, and I don't have a good answer to this, what the platform rules are going to be. Because typically with, say, an active ETF, a platform like a wirehouse or a bulge bracket bank will say you need 3 years or 1 year, whatever the timeline is of live track record. You need a minimum AUM level. And because you're basically just extending the share class of your mutual fund into the ETF wrapper, in theory, you have the track record of the mutual fund, so that checks that box. You have AUM across the various share classes, so that checks that box. So maybe that fast tracks in the mind of some of these asset managers their approval at some of these key platforms where maybe they already have strong relationships through their mutual fund lineup, but they've got a subset of advisors that have just been off limits to them because they don't have an ETF offering. So from a distribution and strategic perspective, it makes sense to me. As far as just the purity of the ETF wrapper itself, and you know, Nate, and you go way back as it relates to ETF coverage and ETF research, that one of the reasons that ETFs have become so popular is the tax efficiency, along with the transparency, and all else equal, they tend to be lower cost than their mutual fund counterparts. And if the ETF is going to be giving a free ride, as it were, to the mutual fund investors in terms of washing away some of the unrealized gains that were embedded in the mutual fund and have sort of lost market share for mutual funds over time as a result of the discrepancy between the tax efficiency of the ETF and the mutual fund. And the mutual fund investors are, for lack of a better word, able to just exploit the in-kind creation and redemption process and wash away some of the low basis shares in the mutual funds. And we've seen it with Vanguard to a degree. That, to me, in some ways undermines the overall objective and the vision of the ETF wrapper as it was designed and created. So I'm a little bit conflicted about it, frankly, but I see it from a number of different angles. I certainly see why asset managers would like to do it. I don't necessarily know why, if you're an existing ETF investor and you bolt on a mutual fund share class, as some filings have proposed to do, that's a good thing for the ETF investor.
So longer term, and we can move on here in a moment, what do you view as the overall impact of this? Todd and I were, I would say, debating a little bit. I think he is less optimistic in the shorter term that this is going to be some huge boon to the industry, but certainly longer term, there are benefits. And I'll give you a stat here that I saw last week, which I think you'll appreciate, and this is from Bloomberg's Eric Balchunas. So he looked at the top 100 asset managers who offer both ETFs and mutual funds, and 92% of them are seeing inflows into their ETFs, but only 31% are seeing inflows into their mutual funds, and then 16% seeing inflows into both. And the reason I bring that up is I'm wondering, are we just going to see sort of a reshuffling of assets once this comes to market, where it's just money moving, say, from the mutual fund share class to the ETF share class, or is there some longer term benefit in terms of growth to the industry?
Well, I think in some ways you've got two opposing forces. So getting back to Eric's stats, and Eric Balchunas is a good friend of mine, so I always watch what he puts out with bated breath and dig into it. I do think that number in and of itself isn't all that instructive, because if you just looked at firms who just have mutual funds, they probably have a small share of that universe that is in inflows. In fact, maybe the number's lower, and so having ETFs and mutual funds maybe increases the share of your mutual fund lineup that's in inflows. But I would venture to guess that the full population of mutual fund issuers has a pretty small slug that is actually in inflows, and most of them, as we know, are actually in net outflows. So that is sort of the darn lies and statistics, as it were. But to get back to your question, I think you've got these two opposing forces where a lot of these platforms are already inundated with so much product and are trying to rationalize the products that their advisors have access to. And so all of a sudden, just because you've offered an ETF share class of a mutual fund doesn't necessarily mean that your path to getting approved on a platform is cleaner. In fact, it might lead to more discussions at the home office level around why do we need this many products? And then when you think about, okay, we've got RIAs in the independent segment, which is growing and is certainly influential as it relates to flows and the asset management industry as a whole. And then you've got the subset of independent broker-dealers, regional broker-dealers, wirehouses, bulge brackets, as they're often called. Those guys are just trying to get to a place where maybe the list is more manageable. They don't have to expend as many resources from a due diligence perspective. And then you're adding the additional share classes of existing mutual funds and how does that compete with the existing ETFs? And so they might reach a decision where they're kicking off funds as opposed to adding funds because an ETF share class has been added, even if, as we talked about earlier, there's a track record and there's a minimum AUM threshold that they're beyond. I think there's longer term implications around how many funds is enough. And I'm not saying that product innovation isn't a good thing and that we haven't seen some really cool product launches in the industry. But at the same time, famously, we have more ETFs than we have stocks in the United States. And at what point is there plenty of ETFs? I don't have the answer to it, but it's a good thought experiment.
Well, I'll tell you who I am not envying in this entire process are fund wholesalers who now have to get in front of advisors and investors and explain, okay, do you want the mutual fund share class or the ETF share class? And to your point, just this growing set of options for investors. So we'll see what happens. I think, ultimately we will get this multi-share class structure probably sooner rather than later, and we'll see what it does for industry growth. But let's move on, and I want to ask you just about the future of the ETF space overall. And again, putting the multi-share class structure aside, I think we would both agree that investor dollars are going to continue pouring into ETFs, right? No different than what we've been seeing. You can look this year, we're likely going to set a new inflow record with somewhere around $1.2, $1.3 trillion in inflows. Yeah, and so the flows are going to continue. The question I have for you is, where does white space still exist for ETF issuers? I think of ALPS, and I mentioned this at the top. You have a very unique lineup of 25 ETFs, and you cover a wide variety of asset classes and strategies, a couple of which I want to ask you about here in a few moments. But as you look ahead, Paul, where is there still room for issuers to innovate?
Well, I think it's a really complicated question because, again, you've got these, in some ways, opposing forces at work. So historically, what we've seen is this steady decline in the asset-weighted expense ratio on ETFs. We saw it for more than a decade. And then last year, Elizabeth Kashner, a former colleague at Index Universe, talked about how we actually saw, and it was incremental, it was a bit, but we saw the first increase in the weighted average expense ratio in ETFs for the first time in more than a decade. And so you've got this overall inflow story into ETFs, like you said, which is just remarkable. $1 trillion last year, likely to be north of $1 trillion this year. Record flows into active ETFs, which tend to carry higher fees. And so all of the progress that has been made in terms of getting access to the market at as low a cost as possible, with as low a friction as possible, as a foundational concept around asset allocation and investment, in some ways isn't being undone, but is being challenged by the increase in mutual fund conversions to ETFs, the launch and popularity of active ETFs, the increasing familiarity and comfort level that advisors and investors have with active ETFs. And so could we see that the weighted average expense ratio of ETFs continue to creep up? Well, why is that? Because a lot of these platforms, Nate, are seeing their mutual fund revenues decline. The mutual fund programs that they had for access to their platform for mutual fund issuers and asset managers have seen a steady decline in revenues as a result of the outflows and the lack of inflows into mutual funds. And so they're trying to replace that revenue with the same type of program, albeit with ETFs. And so if you have a platform now that is asking for revenue sharing on ETFs, then in this world where the fees on ETFs has been going down, that doesn't leave a lot of room for the asset manager to generate profits and to cover the expenses and the overhead associated with running an ETF business or an asset management business. And so I think fee compression is probably going to, at the very least, plateau, if not reverse, in the coming years as a result of some of these dynamics and the ongoing adoption of active ETFs. So that's certainly something that I'm watching, is what the weighted average expense ratio of ETFs broadly is. And if it continues to go up and not down, reversing a more than decade-long trend. As far as white space in ETFs go, I think the answer is we don't know. And that's the beauty of the innovation we're seeing. We've seen single stock ETFs and leverage and inverse ETFs, single stock levered and inverse ETFs. I think if you would have asked yourself 10 years ago, and if I would have asked myself 10 years ago what the sort of next frontier of ETFs is, I don't know that I would have said single stock ETFs with leverage or inverse, or now layering in leverage with buffered exposure. And so the creativity of product development people in the ETF continues to amaze. Whether or not that's to the benefit of individual investors or advisors, another conversation for another day. I'm not the judge or the arbiter of that. But I do think what we've seen in the thematic space as of late is an evolution in how people think about product development in the thematic space, how they think about the application. And it's always been challenging, I think, for advisors to think about the diversified asset allocation and where a thematic exposure fits. And that's one of the challenges with some of those exposures. But ultimately, I think what's ahead of us for ETFs will continue to probably surprise us as opposed to be the most obvious.
So with all of that said, from ALPS's perspective, how do you view competing right now? And before you answer that, I'll give you another stat from Bloomberg's Eric Balchunas, where he noted that there are now nearly 270 ETF issuers. And more remarkably, that number has doubled over the past 3 years. And he said we're on track for 50 new issuers just this year. And we can go back to the conversation we were just having with a mutual fund or the multi-share class structure, which could then have us see more issuers come to market. So just like at a high level, Paul, how does an issuer compete and differentiate in that environment? You mentioned the words creativity earlier. You talked a little bit about fees. Just how do you view that high level?
Yeah, so I think it's getting harder, not easier. And part of that is just all of these new entrants. And you threw out the stat, 270 ETF issuers in the marketplace, probably eclipsing 300 in the not too distant future, and maybe going north of that at some point in the coming years. And that makes it more difficult because there are a lot of talented, smart people working at these shops who are trying to think every day about where their product fits, how it fits, and how to get in front of the advisors and investors with their strategies and tell their story. And so I would say we don't have a good answer to it. We're trying to figure it out on a daily basis with our distribution team, with our research team, with our marketing team, with our PR efforts. And so you have to be creative, you have to be thoughtful, and you have to challenge orthodoxy, I think, in terms of what worked 10 years ago, what worked 20 years ago, what worked even 3 or 4 years ago, and try at all times to test, whether it's the marketing efforts, the distribution strategies, the stories you're telling. And I would say, Nate, not only is it getting more difficult from the perspective of the competition and the stakes being raised every single day, every single quarter, every single year, but also importantly is getting back to the platform conversation and the rev share challenges, the economics of the business are also getting much more challenging. And so you have to be efficient. And I know that word is sort of corporate speak for a lot of different things, but you have to figure out ways to distill a lot of information down to actionable insights around the types of advisors you want to engage with, the types of advisors who are likely to be engaged with your product, and also understand that the various channels, the wires, the independents, the outright RIA firms all operate differently, and a different engagement model is necessary for each of those different segments. And especially in the RIA segment, what we found is you have to be creative. You have to really go out of your way to understand the nuances of that firm, try different approaches, and not just have a blanket one-size-fits-all approach to trying to communicate with them and engage with them, because they're all very different. And even two firms down the road from each other with the exact same asset level and a similar 13F footprint in terms of their ETF ownership do it very differently.
You mentioned challenging orthodoxy with product development. Real quick, before we get to a few ALPS ETFs, I have to ask you about crypto ETFs, just because you and I haven't talked about those before. I've certainly talked plenty about crypto ETFs, but you and I haven't. And so I'm just curious, how does ALPS view that category? Is that something that you would ever consider getting involved with?
Never say never, but I think in ETFs, as you know, Nate, first mover advantage is critical. And we've seen sort of the importance of being a first mover in Bitcoin ETFs, and then now more recently in Ether ETFs or Ethereum ETFs. And we'll see whether the SEC approves a Solana ETF. There's at least when trying to read the tea leaves of the industry, a sense that we're going to get approval for them, and maybe even the ability to stake within those products, which will unlock, in theory, some different value propositions for those products versus the headline Bitcoin ETFs and the application of those strategies. And so we're keeping, as you can imagine, an eye on it, because it's the evolution of finance. I think in some ways, because SS&C, our parent company, touches crypto in the hedge fund administration world, touches crypto and some of the tokenization efforts that are coming out of our London offices, there is some adjacencies to the crypto world and the digital asset world that might not necessarily map to a crypto product, meaning a Bitcoin, Ethereum, Solana, Fartcoin product, but maybe something that is akin to the application of some of the underlying technology, changing the landscape of how you deliver 40 Act products to investors, namely something like tokenization, which we've seen start to gain momentum, whether it's tokenization of money market funds or an eventuality, which I think is likely to happen, which is tokenization of all different types of exchange traded funds and or mutual funds.
Well, my takeaway there with what you just said is, even if ALPS doesn't currently offer crypto-specific products, clearly you're keeping your eye on it and you're clearly in tune with what's going on there. So again, I just think that's an interesting space to watch develop moving forward. Okay, with our remaining time, I do want to make sure we touch on a handful of ALPS ETFs. So maybe think 2 minutes or so on each of these. We can go rapid fire here, but I was looking through the lineup and there were several that jumped out at me. And I want to start with your most recent launch, which is the ALPS Electrification Infrastructure ETF, ticker ELFY. So this debuted back in April, and I feel like this is clearly a big theme now when you think about powering this artificial intelligence boom. This is getting a lot of run, and if you look at performance of this, it's been excellent since it launched. It's just had a tremendous run. So give us a quick story around this ETF.
Yeah, like first and foremost, Nate, timing is everything. And this thing launches in April, kind of around the bottom of the market. So we benefited from a performance perspective from the market finding a bottom and rallying pretty aggressively off of that. But I think you undersell it a little bit when you say this is a big theme. We think it's a massive theme. And yes, AI data centers are a big piece of it. They're driving the forecast for electricity demand growth to levels we haven't seen since the 1960s. If you look at the FERC estimates over the course of the next 5 to 10 years, you're talking about, as a base case, 8% electricity demand growth annually between now and 2030. If you add reshoring and EVs to that figure, you're talking about 15.8% annual growth in electricity demand. Just for reference, we've grown at about 0.4% annually over the course of the past couple decades. We just haven't seen this type of electricity demand growth in more than half a century. And so it's a convergence of AI data center demand, which the numbers around that electricity demand growth are staggering. It makes your head hurt. But then you've got reshoring, which is a policy piece. So convergence of policy some of the massive CapEx spending that's coming from the hyperscalers and the Mag 7 stocks. And then you've also got consumer level trends where switching from ICEs to EVs, switching from typical heating units to heat pumps, switching from, let's say, your gas stove to an induction stove, all of which at the margin means more electricity demand, but in aggregate means meaningful increases in electricity demand. And so what ALPS is designed to do is not invest in the companies that are driving electricity demand growth. So hyperscalers are an example of that. Even NVIDIA, which supplies the chips, and every new chip that they release seems to need more electricity, it's really the companies that are going to benefit from it. So 40% of the portfolio is in utilities, which makes it a little different from a thematic perspective, because most people think themes, they think high flyers and sort of your most aggressive growth companies, whereas ALPS has 40% utilities, and then it's got materials, industrials, technology, and it's comprehensive in its measurement of the theme. You've got uranium mining companies, copper mining companies, as I mentioned, utilities. You've got industrials names who are providing some of the key parts and machinery, construction that is going to ensure and unlock that we're able to meet all of these lofty ambitions around AI investment and those consumer and policy level trends. And I think importantly, Nate, when you just think about the theme in and of itself, this isn't something that's well off into the future. This is something that's happening now. And we've seen examples where data center projects start to break ground, and instead of relying on the local utility, they're ensuring that they have access to clean, reliable electricity through a deal that they struck behind the meter, as it's called. And it speaks to the fact that this is accelerating, not something that you're sort of looking for to play out in the next decade or two. It's going to play out over the next couple decades, but it's starting in earnest already.
Another ETF that stood out to me, and maybe there's somewhat of a similar story here when you talk about electricity generation and those sorts of things. And if you look on the performance side, this ETF has performed fantastic as well. That's the ALPS Core Commodity Natural Resources ETF, ticker CCNR. What's been going on here?
Yeah, so that's one of those cool stories for ETF gearheads like you, where you had this mutual fund that combined futures and equities exposure. And then we spun out the equities exposure in that mutual fund into an ETF. So the origin story of CCNR is somewhat unique in that way, and I think appeals to a guy like you who's been around the ETF world for so long. But it is a product that gives you highly diversified global natural resources equities exposure, run by a team who's been doing this for decades, lives and breathes the global natural resources commodity space. And if you, in fact, believe that some of these megatrends, including electrification, but also emergent consumers around the world, the infrastructure development that's taking place around the world, then naturally the demand for a lot of these key natural resources is likely to increase, putting some pressure on prices. And the companies that stand to benefit from them are these trends, I should say, are in CCNR. And so I would say a lot of investors have structural allocations to core equities, core fixed income, and then they figure out ways to diversify beyond that. And most people just don't have a lot of exposure to these global natural resources companies because they don't necessarily dominate the major market indexes that are typically tracked by your cheap passive beta strategies. And so it can be additive for investors, especially those investors who are looking for ways to maybe capitalize on these long-term secular trends. And the team there at Core Commodity who runs CCNR are some of the best in the business in terms of understanding the geopolitical dynamics, the global macroeconomic environment, and how that trickles down to the various companies in the universe.
All right, the last ETF that I have to ask you about, and I know we've discussed this before, but I still think it's highly relevant, and that's the ALPS Equal Sector Weight ETF, ticker EQL. And you can certainly talk more about that ETF if you like, but it's interesting, Paul, because traditional market cap weighted indices, as you know, they've continued to run. And I think everyone is very well aware those indices are very top heavy right now. They're obviously highly concentrated in the tech sector, but that's continued to work for investors. And so what's the case for equal weighting sectors right now?
Well, I think, Nate, coming into the year, a lot of people were a little bit concerned about valuations and uncertainty around policy. There was some optimism around deregulation and some of the other side of the policy framework from the current administration. But a lot of people's default choice to get away from the cap-weighted view of, say, the S&P 500 is to equal weight the stocks in the S&P 500. That's been a very popular strategy. The products that do that have seen significant inflows even here in 2025. And our argument is, if you're trying to capture some additional breadth from the market, so the other 493, if you will, in the S&P 500, doing so by just equally weighting all of those stocks in the market isn't the most effective way to do that. By equal weighting sectors, which EQL does, what you're doing is you're keeping the integrity of a given sector. So take, for example, energy. You're ensuring that you still have the most weight in energy to the largest companies, Chevron and Exxon, in the case of energy. In the case of consumer staples, you still have the most exposure to the biggest companies in that sector. But importantly, you're giving the same weight to sectors like staples and utilities as you're giving to technology. So naturally, that brings down the overall volatility of your large cap allocation while ensuring you still, within each sector, have the most exposure to the largest companies with the most earnings and the most revenue. And unlike single stock weighting, where you're equally weighting those individual stocks, it is a more defensive approach. Equal stock weighting is actually a higher beta approach on the S&P 500. And what you end up doing actually in an equal stock weighted portfolio is just having more exposure to the sectors that have the most companies, which isn't necessarily a academically aligned investment philosophy. And we think EQL is a really good option, or potentially a really good option, for advisors and investors who are just a little bit concerned about concentration, what history tells us about high concentration levels in the market, extended valuations in the market in terms of forward-looking returns.
With an excellent ticker again in EQL. But Paul, we're going to have to leave it there. Fun chat this week. I feel like that was a really nice tour around the world of ETFs. We covered a lot of ground there, but thank you for joining me.
Enjoyed it, Nate. Always good to see you.
That was Paul Baiocchi, Chief ETF Strategist at SS&C ALPS Advisors. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Travis Spence, who is Global Head of ETFs at JP Morgan Asset Management. And I'll also be joined by Jillian Del Signor, Head of Retail and Wealth Strategy at NASDAQ Indexes. Should be two fantastic conversations. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities. And anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.